How's it going, everyone? This is Mike with InvestTheory.com. Welcome to our final episode and conclusion to our 6-part series on vertical option spreads. As a recap, vertical spreads are one of many different strategies used to trade options. They can be very lucrative, just like other spreads. A vertical spread requires the trader to both buy and sell an option contract with the same expiration date in order to enter a trade at a lower cost. Now, vertical spreads often have a lower risk associated with them and become more appealing to traders than buying a long call or put. Since there is limited risk, there's also limited profit as well. Now again, the vertical spread requires you to purchase a buy and a sell that share the same expiration date. The strike price of the buy and the sell need to be different. The 4 types of vertical spreads are the bull call spread, the bear call spread, the bull put spread, and lastly, the bear put spread. Each of them have their own strengths and purposes. The bull call spread is a bullish position. In order to set it up, the trader needs to buy a call option with a lower strike price, simultaneously selling another call option with a higher strike price. And again, both the calls will need to have the same expiration date. Now, the reason why we would want to set up a bull call spread is because we believe the underlying stock will have a moderate increase in value, meaning we think the price is going to go up, but not by a lot. So using the bull call spread strategy allows us to enter into the trade with a cheaper overall price than if we were to go and buy long calls. The bear call spread is a bearish position. In order to set it up, the trader needs to buy a call option with a higher strike price, at the same time selling another call option with a lower strike price. Again, both calls will need to have the same expiration date. Now, the reason why we would want to set up a bear call spread is because we believe the underlying asset or stock will have a moderate decrease in value, meaning we think the price is going to go down, but not by a lot. So using the bear call spread strategy allows us to enter into a short position while at the same time limiting our risk. The bull put spread is a bullish to neutral position. Now, in order to set up this one, the trader needs to buy a put option with a lower strike price, at the same time selling another put option with a higher strike price. Again, these share the same expiration date as well. Now, the reason why we would want to do this is because we believe that the underlying asset or stock is going to have a strong increase in price or is going to remain neutral and trade sideways for a bit. So using this strategy allows us to capture the profit from any upwards momentum or time decay if the options expire worthless. The bear put strategy, it requires the trader to purchase a put option with a higher strike price, at the same time selling another put option with a lower strike price. Both puts need to have the same expiration cycle. The reason we would want to take this trade is because the bear put spread is because we believe that the underlying stock is going to have a strong decrease in price in the short-term future. Using this strategy allows us to take on a short position with limited risk and less upfront capital. Now, the question that I see most often is, when do we open a vertical spread? And when do we just buy a long call or put? Now, there are a couple of reasons why we would want to open a vertical spread. First, vertical spreads are great for moderate increases and decreases in stock price. If we suspect the stock to make big moves, we probably shouldn't open a vertical spread. Now, sometimes we might be waiting on a catalyst to occur. So if we don't know when that catalyst is coming, it might be a good time to open up a spread because of this unknown factor. It kind of makes it more sense for us to limit our risk, try to capture that sideways trading motion until this catalyst occurs. So a good example of this would be like a biopharmaceutical company when they are waiting on an FDA approval or trial news. So let's say we expect there to be news sometime in the month of November, and we feel pretty bullish on this, but we could buy a long call before the option prices increase along with implied volatility, but that could really hurt us on the back end with time decay. So instead, we could open a vertical spread, That way, if up until the catalyst occurs, the price has little to no movement, maybe it just goes up and down a little bit, we can collect profit from that sideways trading. And if for some reason the catalyst comes sooner than expected and it's good news, well, then we will hit our max profit and we're going to see a strong increase in the stock price and we're going to take gains. So at the end of the day, we're going to be winning. So in essence, vertical spreads allow us to trade the same scenario in two different ways. Now, lastly, vertical spreads allow us to define our risk. This is so important. They are great for small accounts due to the fact that they require less upfront capital in order to enter into the trade. So this concludes our series on vertical spreads. We hope you found this series helpful and we encourage you to try opening a vertical spread on your own. Lastly, if you would like to join a fun community of traders to hang out and share ideas with, look no further. Invest Theory has brought over 3,000 traders just like you together in one free Discord chat. Join by clicking the link in the summary today. See how we can help you become an even better trader. Let's learn together. This is Mike with InvestTheory.com signing out.